All right, welcome to the third module here. This is the very first lesson in the third module, and this is called Determining the Quality of Earnings. And to start off, let me just describe what we mean by quality of earnings. So this term is referred to the amount of earnings that's attributable to higher sales or lower costs rather than artificial profits that are created by accounting anomalies such as inflation or inventory. So when you're making an assessment of a company's quality of earnings, it's important to note that the reason you're doing this is more based on determining whether the numbers you're seeing today give you assurance that there'll be similar numbers into the future. So for example, when a company reports a massive growth in profit, and sometimes you'll see this in the news where, call it Apple, had a huge jump in their bottom line profit and it went up 20% or something very large. That should be a really good thing for the company if you were just looking at it on the surface and saying, wow, their net income grew by a lot. But sometimes individuals pay too much attention to this higher price and they buy it because of that jump in profits. And what they don't realize is that there was some accounting gymnastics that took place in order to create that big giant spike or that big giant jump in the bottom line. So that wouldn't be necessarily sustainable as you look at future quarters. And a person might have bought into that company simply on that big jump. And through doing this assessment of quality of earnings, you're able to see that maybe that was an accounting anomaly opposed to something that was actually sustainable and produced from their revenues of the business. So in this lesson, what you're going to be doing is you're going to be comparing that net income number that you find on the income statement, and you're going to be comparing it to some numbers that we find on the cash flow statement. And at the very end, we'll also take a look at how we could compare one of these numbers to a figure on the balance sheet as well. So the quality of earnings, you're really talking about the bottom line here on the income statement. That's the net income. This is the profit that the company's generating. What we're going to do to start off is I'm going to show you on Morningstar the net income of two different companies, and then I'm going to show you the free cash flow of those companies to show you how this quality of the actual numbers and the actual cash flow that you're seeing coming through the business is a little bit different than what you're actually seeing on the income statement. Now, the main reason for this is that the number that you're seeing on the income statement, that number is not all cash numbers. So you've got depreciation, which is being accounted for on the income statement. You have other non-cash items, which are being accounted for in the income statement. And what happens is whenever you're basically accounting for these non-cash items, it's really difficult to actually see the amount of cash that's flowing through the business, almost like blood flowing through the body. That's how cash needs to be incorporated for your understanding of in a business is when that cash is flowing through the business at a plentiful rate, that is a really good thing because that gives the company the flexibility to go off on new ventures, to buy new things. When a company is cash strapped, meaning they don't have any, that's when a company really loses control of their destiny and it's hard for them to actually control what the heck's going on. So you're going to have a hard time determining whether the company has a lot of cash flowing through its system by just looking at the income statement. So when we do this comparison of looking at the income statement, the bottom line on the income statement, the net income, and comparing that to what we find after we make adjustments for non-cash items, what we find is we get that free cash flow number that you were using in the second module. But by comparing these two together, that's your quality or kind of your ratio of the quality of the earnings. So let's go ahead and do this with Morningstar. I do want to highlight that we're currently in the process of building a website called TIP Money, which you'll be able to do these same analysis with 10-year data on TIP Money. So you might want to look for that if you bought the course later on, maybe a year after we launched this. If you're listening to this after that, you might want to go to TIP Money because we'll have all this laid out and it'll be pretty user-friendly to find some of these things. Okay, so I'm going to do two different examples. I'm going to use Facebook and I'm also going to use Chevron. I think the important part of why I'm choosing these two different companies is to show you that even though a company might have a strong quality of earnings, it might not be a company that you necessarily want to buy. It might not also. You can't really determine whether something's going to be a business that you actually want to buy based on the quality of earnings. But what it is, it's helping you determine the trend of whether a business is having more cash on hand, they're losing cash, or the trend is showing you that they're having less and less cash to play around with as the company progresses through time. So we're going to use Facebook to demonstrate a good quality of earnings, and then we're going to use Chevron to demonstrate a poor quality of earnings. So I've pulled up Facebook. If you'd go up here to quotes and you type in FB and you hit enter, it's going to take you to the page that I landed on here. To demonstrate to you this quality of earnings, let's go to the key ratio tab. And you can see here's this is 10 years worth of data for Facebook. And you can see in 2010, that's when they became public. So that's when their numbers started showing up. And the columns that we're going to be looking at is net income. This is the total net income, the bottom line or the profit of the business. And you can see here in 2010, they posted $606 million. 2011, they had $1 billion of profit. And so that's what's being reported on the bottom line of the income statement, these numbers right here. So now if we go down to the free cash flow line right here, you can see the numbers that the company is actually seeing in cash. And this is after they make their capital expenditures for buying more tangible assets to keep the business running and sustainable. So this number here is what we're going to be comparing to the net income, which is right here. This is after taxes, the number of the profit. And then this is the free cash flow. This is the cash they actually see being pumped through the business. So when you look at this, Facebook actually has more free cash flow than what the net income is showing. And that could maybe be attributed to a bunch of different things. But in short, these capital expenditures that they're making right now are actually lower than the depreciation costs and some of the other non-cash items that they're adding back into in order to get their operational cash flow and then ultimately their free cash flow. So that might have sounded kind of confusing, but this is the key takeaway if you don't want to get into all that jargon. Key takeaway is the closer you can see this free cash flow number right here to match that net income, that is a good thing. When that's almost a 1-to-1 ratio, that's a really, really good thing for the business. When you get into businesses that don't have a good quality of earnings, you're going to see that ratio is maybe 50% of what they're displaying as net income actually materializes into free cash flow and dollars being pumped through the business. So what I want to show you is a little tool that's nice on Morningstar here. It's the cash flow tab underneath of this. And if you click on that cash flow tab, there's actually a ratio that gets into this quality of earnings, which is free cash flow to net income. And what you can see here is you can see that the number has been, there was one year, or their first year was a 67%. Here it was 94%. This year was something crazy that happened. You'd have to dig into the 2012 financial report in order to see exactly why that was so above and beyond the net income. That's a good thing. And then you can see the rest of the years, it's always been slightly above, which, if I was trying to make sense of that, of why that was happening, my guess, without having read all those different financial statements, my guess is that the company is spending a lot less on some of the capital expenditures that they're making right now than the capital expenditures that they made in the past that they're depreciating at a very high level right now onto those income statements. And that's why you're seeing that number being higher. That's what I would guess. But that could be wrong. But that would be my intuition as to what I would think would be going on there. So now let me do this with another company. Let's do this with Chevron. Okay, so we just typed in Chevron and CVX is the ticker, and it brought you back to this key ratios tab. And so if we're looking at the net income, you can see here's the number for the net income. These numbers are in millions. So that would be 17 billion, 18 billion. And you can see that the net income has been getting punished more recently because there's been a huge downturn in oil prices since the 2014-15 timeframe. You've seen the oil prices really start to go down. Now, in the beginning of 2017, we're seeing them start to come back up, but don't know if that's sustainable at this point. So the key thing that we're looking at here is this net income to free cash flow difference. So you can see this first one, 17 billion to 10 billion, 18 billion to 8 billion, 23 billion to 9 billion, 10 billion to a negative 500 million. And so you can see that the quality of earnings here is much, much lower than what's being reported on the income statement. And that's really, really important to understand. All the stuff that you learned in the second module with Stig on how to determine the intrinsic value of a company, you're taking these free cash flow numbers. So even though the company's reporting this on their net income, you're not using those numbers in order to determine those values because you're looking at free cash flow to come up with that valuation of the business. So it's already baked into what you learned in the previous module. But it's important that when you're analyzing, let's say you were scanning some different stocks and you saw that the PE ratio was something that was good, call it a 10. And you're looking at that net income because that's where the PE ratio is being pulled from. It's coming from this net income. It's not coming from your free cash flow number. So you might see, oh, wow, this company has a fantastic PE ratio. Let me dig into this and explore it some more. You might want to look at the quality of earnings because if you do that real quickly, just eyeballing this, we can see that the free cash flow is almost like half as much as what the net income is. So if this company, let's just say this company had a PE ratio of 10, we now know just by looking at the quality of the earnings that it's actually maybe a 20. The PE ratio might actually be a 20 because the actual cash flow that's being produced is half as much as what you're actually seeing on the income statement. So that's a really strong consideration. So let's go back to that shortcut and look here at the cash flow. And as we get on to the cash flow to net income, you can see it's a 0.61, 0.44, 42%, 0, 62%, 54%. So those numbers are really ugly. And that's something that you would really want to look at more on the filtering side as you're going through different picks to quickly realize that you might have a fantastic PE ratio, but there might be a reason why it's down there. And most likely it's because the quality of the earnings and the free cash flow that the company is actually producing. All right, so let's go ahead and pull up Facebook again, and I want to show you a comparison between the income statement and the balance sheet. Something else to kind of look at for the quality of earnings. This would be called the quality of revenue, or the top line. So we pulled up Facebook, and then you're going to have to click on the Financials tab here in order to pull up the income statement. Morningstar gives you 5 years of data for the income statement. And what we can see is the revenue for Facebook has gone from 5 billion, 7 billion, 12 billion, 17, 27. So their revenue is growing like crazy. It's going up a ton. This is not normal growth, to be quite honest with you. But for the type of business that it is and the fact that they're doing advertising and stuff, they're really kind of finding themselves as a company. This company is taking off with that revenue. Now, if you wanted to look at that revenue growth and say, well, maybe they're doing things from an accounting standpoint to produce those numbers. And really the only way a company can manipulate their revenue or their top line number, and this is one of the most raw numbers that you can deal with when you're looking at a business, because it's really hard to manipulate your top line. Because if you're selling a Coke or you're selling whatever product it might be, it's hard to make up the quantity that you're selling. That's just like such a basic number. But there's one way that a company can actually manipulate their revenue, and this is by adjusting the way that they allow the customer to buy the product. So if the company extends a line of credit to the customer, you'd see this a lot in car companies. Let's say that Ford Motor Company wants to extend credit in order to increase revenue or increase their top line sales. And that might be a good company to pull up, would be Ford. And we'll pull up their financials and we'll look at their revenue. So when we look at their revenue, their top line, you can see that the revenue has gone up just a little bit here. It's not too bad. But if we were concerned as to Ford extending a line of credit to their customers in order to boost this top line, you would have to then look at the balance sheet and do a comparison of how those two numbers compare. So you'd be comparing the revenue with the balance sheet. And on the balance sheet, the number that you're looking for would be receivables. So as we look at the receivables, it's gone from 82 billion to 87, 92, 101. So we're seeing that the receivables are going up, and these receivables are money that is owed to the company. This could be through the money that's owed from a dealership to the Ford Motor Company. So when we look at this receivable line, it's going up, and in general, we would expect that number to go up as long as the revenue is going up as well. And that's what we saw. But what you have to look at is you have to do a percentage. You have to compare the receivables for each one of those years to the revenue that was growing and take that as a percent. And when you take these numbers as a percent, what you're going to find is whether the company is making their lending that they're giving to their vendors more lax, or they're tightening that lending to see whether that's actually happening. And the way you determine that is you'd take this receivable, divide it by the revenue, and then you could track that trend. I personally don't find this to be too much of a concern. If you had an industry that, like the car industry or stock that was extending a lot of credit, and you think that maybe they're boosting their top line because of that extension of credit. So that wraps up this first quick little lesson about the quality of earnings. Again, this isn't something that should impact your intrinsic value calculations too much, but it is going to help you as you're looking at different companies to quickly take a peek at that quality of earnings before you dig any deeper or you go much deeper into a company that you think might be a great value pick.